Gold is really cruising today. We've had a big day in the upside. In the spot market, we've got a spot price right now of about 915. So a significant rally. You can see what's going on here with the ETF GLD. This is one of the largest ETFs in North America by asset value. The GLD is, and it's a convenient one to start talking about it because any trader can get access to this. If you're not doing too in-depth of analysis here, it can be pretty handy. So GLD is way up, and normally we would expect to see the Aussie really gaining value, and yet, of course, as a lot of us know, the Aussie is declining significantly. Now we're closing in on this is the spot for the Aussie US dollar. We're closing in on a potential resistance level. We've been here at the end of May, beginning of June. Both the Australian dollar and gold have been struggling a bit since late February, early March to make some ground. Gold more so than the dollar or than the Aussie dollar. But one of the real takeaways here is that typically these two move in generally the same direction. But once in a while they don't. So today we're getting this big divergence. Now there's a lot of underlying fundamental volatility right now in both with the Aussie dollar as well as the U.S. dollar in general that's disrupting some of this. But it creates an opportunity in that what I have noticed is that the market tends to kind of stretch out away from these paired relationships. So, for example, the Aussie beginning to weaken at the same time that gold is rising in value on a very weak dollar. And then we get this snapping back into formation where one market comes back into alignment with the other. And typically, I've seen that the market that it has pushed out further, which in this case would be gold, it tends to be the one to drag the other market with it. So on a relative basis, we see gold really taking off ahead of the Australian dollar. Well, one way to look at that interesting opportunity is if that kicks off a renewed trend, or a continuation of this recent run up that we've had on the Aussie since the beginning of June, we could have some nice opportunity to the upside. If we're looking for a breakout, we may look for that breakout to occur, as of exceeding yesterday's highs, which would be around 9,600 even. Or I suppose even more conservatively, we might look at a breakout up above resistance level here, which is at about 9,620 or so. In either case, if the market reverses and begins to chase gold here on the Aussie dollar, and in fact exceeds one of those two levels, where might we project that the market could go? Is it worth the risk? Well, one way that I might do this is by attaching a Fibonacci retracement to the high and the low of the previous consolidation, which is, so we're dealing with the breakdown here in early June, a couple of weeks ago, from about 96.50 down to just above 93.25 or so. That puts our 161.8% projection level up here at 98.50. There's some nice upside there. That's 250 pips or so to the upside. Potential could be a nice rally to take advantage of should the market break out the direction that I think that it might. One other comment that I would make here, besides looking at this from the perspective of seeing an opportunity for a directional play to the upside, which I think there's a fair amount of predictability here in assuming that the Aussie dollar is going to chase gold to the upside, but against a weak dollar. But one thing that we can take away from this, what's even more predictive in my experience, when these paired markets, such as the Aussie dollar and gold, begin to diverge from each other, especially quite dramatically, is it's very predictive for volatility. Well, what's good to play in volatility? Well, straddles and strangles are also very attractive opportunities. They're obviously more expensive from a certain perspective in the outright capital outlay initially, but they have fixed risks. So as an alternative, so an option straddle as an alternative to an outright spot position with a stop loss, which may ultimately be more expensive if you're stopped out or whipped out. But the straddle itself has fixed risk. You can't lose more than what you paid to get into the position itself, and still has an unlimited upside potential. So if the market really moves one direction or the other a lot, that's where you find yourself in that profitable position. So maybe two ways to look at this opportunity is the market is already drifting to the upside here after hitting some lows down around 95.50. I'm beginning to think that there may be the opportunity here in the short term, even in the next few hours.